Hey everyone, this is Bob Teska with Bowers and Company CPAs, and we are having our second installment of our Reagan Roundtable. We have the same partners in crime here currently. We have myself, Fran Lowther, who's a bond manager with Reagan, Jim, who's the commercial risk manager, and Kevin is also a commercial risk manager. How you guys doing?
Excellent.
Great today.
Very good, Bob. Thanks for having us.
Since you guys can't see us, I'm just going to tell you that we all look better in pictures than we currently do in person.
It hasn't been
So here are the topics we're going to cover today, and I think we are going to start with Fran talking about being a little bit strategic about 2021.
Yeah, I think we have a pretty simple message today that's going to not take a whole lot of time to go over. So just some of the things that we want to bring to light, and I think most people at this point of this pandemic have really looked seriously at and worried about what is next. We're always worried about what is next, especially in 2021. So just to go over a few kind of startling things. Tom DiNapoli yesterday, the AGC hosted a webinar on Friday, I believe it was, where the state comptroller talked a little bit about the current conditions and where we're at. So I just want to bring a couple of those things to light just to kind of backdrop what we're talking about and the importance of what we're suggesting here today. The economy, 12.5% unemployment for the month of August in New York State. So from March of 2020 to April, 1.9 million jobs were lost in New York State. So all of this, the isolation and the reduction and all the COVID measures that we've taken in New York State has resulted in a sales tax revenue decrease of about 27% over last year. Personal income tax revenue is also down by 13% versus this time last year. So you just see there's a huge budget gap, and I know we're not talking, giving any information that people don't already know, but we have a budget gap in New York State of $14.5 billion. So that will inevitably impact what the outlook is for especially construction businesses in New York State for 2021. So bottom line, if the federal government doesn't get its act together and provide some federal funding, we're going to be in a world of hurt. I think New York State is looking at an $8 billion budget cut for 2021. So that is the backdrop of the significance of what we're talking to our clients about and what we wanted to just touch base about today. And really what that means, what I'm suggesting we all do is take a very serious, thorough look at your costs. What exactly are your costs? What are your G&A for next year? And really have a firm grip on what that looks like. And then take some simple measures. First of all, again, not rocket science, but restrict spending. Really take a look at that equipment purchases and really be strategic on what you're doing from a purchase standpoint. I think at this point, and I don't know if I'll ask Bob to give his personal opinions on cash. Cash is king, so you really want to be as liquid as you possibly can for 2021. One of the things that we suggest people do is we have a tool, we kind of call it the What If Financial Statement, and this is something if you want to contact Bob or myself, we can provide to you. But it's a real simple tool, an Excel spreadsheet where you take your historic financial information, you take your most previous financial statement information, and you plug those numbers in, and the statement allows you to tweak if your G&A increases, if your project profit decreases, if your revenue decreases, if your equipment debt increases. This will impact the projection for 2021. That's a real simple, quick tool that you can use as you plan for 2021. So most importantly, in general, overall theme of my little speech here is just to remain disciplined. Be knowledgeable about your balance sheet, be knowledgeable about your expenses, and just remain disciplined. And that translates into bidding. The last recession, I think a lot of people got into a situation where in a frenzy to make sure you had that revenue for 2021, which is a legitimate concern, of course. They took a lot of cheap work, and that had ramifications for contractors 12, 24, 36 months out because of that deficit or that reduction in project profit. So as you look at your backlog, look at your overhead. What do you need? What is the minimum? And what can you do strategically in the event that that backlog isn't going to be where it was in 19 or in 20?
Hey, Fran, you said that unemployment was around 12%, for New York State. I guess anecdotally, do you know how your contractors are faring as far as being able to find people? Are they being able to find more workers? Is it still a pretty tight contract market?
Yeah, anecdotally, I think that we've had the same problems in construction that we've always had. We've always had a deficit in the labor force, and everyone has been concerned about an aging workforce. But for the most part, we're getting things done. I think that will remain a concern. And if this is a prolonged thing into 2021 and God forbid 2022, you're going to see some of those aging workers, those key guys that are going to look at this and look at their age and say, you know, this isn't worth it anymore. So I think we're going to continue to see that trend. And this COVID-19 crisis does not help our labor issue.
Right.
No question.
I don't know if you guys have seen anything different, but anyone I've talked to, they're feeling the same crunch from a labor standpoint that they have all along.
Yeah, one of the things that we hear repeatedly is that you can't even find a body, let alone a qualified a body, and it's been a problem that existed before COVID, but it certainly has increased. Some guys aren't comfortable going back out into the workforce, which has only added to that. So we are certainly seeing that across the board.
Yeah, I think simply put, I think we need to be concerned about that labor, be concerned about productivity, be concerned about your supply chain, remain disciplined, and control the things that you can control.
Yeah, I agree. I guess from a backlog standpoint, I'll just comment that, again, this is more anecdotally based on my client base, but most of my clients are doing okay currently. If they're real specialized, anyone I've got that's a very specialized contractor, they're hurting. I have a client that does geothermal drilling. A lot of that's for colleges. They're struggling. Anyone I have that focuses mainly on schools, they were able to burn off their backlog, which was kind of great because for now we don't have they don't have the backlog they thought they would heading into summer. And now you have more bidders going after the same work, and you end up in what could be that repetitive loop of can I do it cheaper? Can I do it cheaper? And all of a sudden I'm not going to make money on this. Maybe I can make it up in change orders.
Yeah.
So that's where I've seen the most challenges as it relates to backlog. I think another analysis that can be done would be a break-even analysis, where you find out what revenue you have to book in order to cover all your expenses, and you can kind of back up from there. Can I take down some of the overhead like Fran was talking about, and if I do that, then where's my break-even analysis? Maybe it was $10 million last year. I had to make $10 million, have a break-even year. It would be zero, nothing lost, nothing gained, but I covered all my expenses. Maybe I need to back that up. Maybe I can only get $8 million. If I'm only going to get $8 million of revenue, what cost structure do I have to be able to accommodate that? What purchases do I have to forego, put on hold? My advertising budget has to go down. I'm probably not going to take a bonus at the end of the year, stuff like that, to work those costs down so that you can work within the structure that you have going into 2021. From a tax planning standpoint, tax planning is something we encourage our clients to do every year. Around in the end of the third quarter into the fourth quarter, we're looking at September or October numbers and doing a little projection out to the end of the year, see where they're at, and what can we do to mitigate our tax liability this year. I think that's more important than ever this year with everything that's up in arms. You've got in some cases, you might have more revenue than you thought you were going to have because you're able to burn off all this backlog. Well, what does that mean? We have the whole situation with the PPP loans that were supposed to be, not taxable, but then the Treasury came out and said, well, it's not taxable, but the expenses aren't deductible, which essentially means it's taxable. So, that loan, if it's forgiven in 2020, is going to be, subject to an act of Congress, is going to be taxable. So I think that comes into your tax planning this year. Do I try and get the loan forgiven this year? At this point would be taxable, or do I push it till January, get it forgiven in January, then I got all of 2021 to figure out if Congress is actually going to act, and because there is talk about there being an act of Congress to make the PPP loan, the expenses essentially deductible, meaning that the loan would be not taxable. If you do get it done, forgiven this year, and, there is no act of Congress, and then they do it in 2021, you're going to be able to amend your tax return. But, there's going to be, some extra shuffling around there. And then the other thing to consider is, one of the things that we always look at for tax planning, a very easy, simple method is, are there any purchases we need to make so that we can, depreciate them? Take Section 179 or bonus depreciation. That's a really easy one, and a lot of people like to do that. They'd rather, buy a piece of equipment to pay tax. The thing I would caution on that is you really got to look at the economy and what your backlog is going to look like in 2021 and 2022. The general, consensus is that, the construction industry lags the general economy by 12 to 18 months. So in 12 months, are you going to have the backlog to support that payment for that shiny new piece of equipment you bought? Or are you going to have the backlog and the working capital to be okay if you paid cash for that shiny new piece of equipment? That piece of equipment isn't going to help your bonding capacity. It's not going to help you pay your payables. It's not going to help you pay your labor. So I think those are all things to consider. Tax planning is going to be more challenging this year than it has been in the past.
Yeah, with the bonding concern, that working capital is an all-important calculation that you have to be mindful of, along with that debt to net worth ratio. But the working capital is a key component to the decision-making process of a surety underwriter.
All right. I think that's all for me and Fran, unless we attempt to say something intelligent to you guys and talk about the insurance.
Yeah, thanks, guys. Just changing gears a little bit. We're certainly entering into and are in the throes of a hard market from an insurance standpoint. There's several factors that are driving that. We'll spend a few minutes talking about those, and then I'll turn it over to Kevin and let him give some strategic ideas on what you can do to mitigate what's going on in the marketplace. So with that, there's really like four factors that are really driving it. Reinsurance capacity is at an all-time low, so our insurance carriers are paying more for their insurance, which is just a pass-through to the policyholder. So whether we're talking commercial or personal, we're all feeling it and are going to continue to feel it. COVID-19 on a global basis is having a significant impact on insurance as well. And then from a natural disaster standpoint, we've had a very active year between hurricanes, typhoons, the fires in the West. All these things, while we're here regional sitting in Syracuse, New York, impact us, and they're impacting us very significantly. And then what's actually going on in the marketplace within each line of coverage. So I'll kind of break it down by general liability, auto liability, workers' comp, and umbrella, and kind of give you an idea of what's driving each one of those lines and what to expect from an increase standpoint. So from a general liability standpoint, we've really got a highly organized plaintiffs bar, which is working against us. We're seeing a lot of nuclear verdicts as a result of this. Carriers are really questioning and reevaluating their loss reserves on the claims because of those verdicts. So all those factors really negatively impact an aggressive renewal from a general liability standpoint. So with that, we're forecasting on a good end, a good account that's performing well, that has good policies, procedures, and practices in place, anywhere from 7.5% to upwards of 15% on renewal. That isn't taken into consideration if you've had losses. If you've had losses, that number is only going to be pushed up further. So we're talking significant dollars here, especially when you see and you add them up as we go across each line of coverage. From an auto liability standpoint, on a nationwide basis, it's distracted driving. The days of fender benders are long past us. If in fact you do have a low speed type of accident, think about it. Your bumpers are full of technology, so a fender bender, as we said, which no longer exists, would have been a $2,000 claim. Now it can be $15,000, $20,000 for just a little low-speed impact type of accident. So, the cost of claims has gone up exponentially from an auto standpoint, and distracted driving is really what's driving that. So again, on that line of coverage, we're seeing anywhere from 8%, again, to 15% and higher, depending on what your activity is. Fortunately, from a workers' compensation standpoint, New York State specifically kept things pretty flat. There were minor fluctuations there. Most coasts stayed flat. Some went down, some went up. But the challenges there are opioid addiction. Fran touched on it, and Bob touched on it before. Aging workforce. Our guys are breaking, their bodies break down over time, and there isn't that flow of new young blood coming in, and so there is a workforce issue, and the aging workforce has a significant impact on the workers' comp claim. They're being paid more, so from a indemnity standpoint, that increases the cost of the claim, and you don't heal as quickly. It's just it's kind of a double-edged sword there. So it's something that you really got to monitor. You got to make sure that you're training your guys. You got to make sure that you're providing them the proper PPE, getting them the assistance. Have the young bucks assist them where they're where things are getting difficult, or there's some heavy lifting involved. And then really the one line of coverage that is harder than any other, as we say in the industry, is the umbrella. And this is where these nuclear wars that have been going on for the past 10 years are really, really having an impact. If you're a high hazard company, a roofer, or somebody that's just, that's in one of those higher rated classifications, we're seeing significant increases here. So in a good case, anywhere from 50%, to 150%. If we've seen somebody that has had losses that have pierced the umbrella layer, I hate to say, tighten up your bootstraps, but tighten them up, because, we've seen increases 600+%. These are catastrophic type of increases that, when you bid work and your renewal doesn't line up with the work that you're having, you don't have that cost built in. And it's not like you can submit a change order to the school, because your insurance costs have gone up. So when we talk about a hard market, we are absolutely in the throes of it. And I don't see this changing anytime in the near future. So, with that said, the best thing that you can do is prepare for it and do anything you can internally, which Kevin will talk about, to positively impact, your renewal.
Yeah, thanks, Jim. We are absolutely entering the hard market, and having a proactive, strategic approach to your renewal is more important now than ever. Really having communication with your broker, over communicating right now is certainly not a bad thing, both so you have an understanding of the changing marketplace, but also so your broker can present you to the underwriters in the best possible light that you can be presented. So we need to be strategic about this renewal, and by that we mean it doesn't make sense to just shotgun a submission out to every single insurance company out there, because they are busy right now. They know the marketplace. Everybody's taking a look at alternative programs. We want to be strategic about it and identify a handful, 3 or 4 other carriers that will write your type of business and can write it competitively with all the coverage that you need in order to operate. Identify those, and then work with your broker to have him or her understand how can we present you to the marketplace the best possible way. So if you do have active claims, this is critical, and Jim alluded to it a little bit, particularly with the labor law claims here in New York and any significant auto claims. We need to understand every single aspect of that claim, from the root cause to what could have been done to avoid that, what have we done since that claim to mitigate this from happening again. Like Jim said, we're having one labor law claim, and we're seeing 600% increases on umbrella, and that's a reality right now that, quite frankly, some businesses just aren't set up to even weather that. So we really need to have a great understanding of not only what happened in those incidents, but what did we do proactively to mitigate that going forward. Take advantage of the resources and tools that your broker can provide to you. Compliance is a big thing right now. Make sure your subcontractor agreement is up to date and as current as it can be with the legal language in there to insulate you and transfer that risk. When's the last time you've taken a look at your safety manual and had that updated to be compliant both state and federally? Same thing applies to your employee handbook. You know, these are all things that we look at, and we as an agency at Reagan, we have the resources to help you with this stuff. When it comes down to actually getting that renewal processed, all of this stuff needs to be communicated very clearly to the underwriter so that you're presented as a best-in-class organization that deserves best-in-class pricing as well as terms and conditions for that renewal. So it's something that definitely takes a little bit more work on everybody's end, but if done the right way and properly, it can certainly result in a much better renewal than just shotgunning out applications everywhere and comparing quotes. So, you know, it is a challenging time, but if done properly, it is manageable.
Yeah, like, again, the only thing that I would add to that too is it is a great time to take a look at alternative mechanisms as well. You know, when you've got to do something to defer some of that cost, maybe looking at your deductibles, can we afford to do a high deductible plan? Is that going to have enough of an impact to have, you know, a significant reduction in our upfront premium? You know, captive type programs. There's never a better time to get creative than right now, because just doing what you've always done is not going to be enough, and it's going to have a significant impact on your bottom line.
All right, Fran, we didn't have anything intelligent to say.
Nothing to add.
All right, let's end with who's going to win the Super Bowl? Kevin.
Who's going to win the Super Bowl? I'm going to go with the Buffalo Bills.
Wow.
Yeah.
He also has nothing intelligent to say.
Well, I'm a lifelong Raiders fan, so, you know, we've got a new beautiful venue that I hope to get out to see in Vegas, so I'm going to go with my new Vegas Raiders.
Fair enough.
Yeah, this is a tough one. It's not going to be the Giants either. The local teams aren't looking good. I'm going to go with Kansas City.
I think I might have to agree with Fran on that one.
Oh, of course.
Safe play.
Yeah.
Safe play. You know, your CPA and your bond guy.
All right, very good. We want to thank everyone for joining us, and I'm sure we'll be out in another quarter with another roundtable with some more exciting insurance and bonding topics.
Thanks a lot.
Thank
Bob.
you.
Think about it.